Most traders start with the basics, drawing a few trend lines, marking support and resistance, maybe throwing on a moving average. But if you're ready to take things up a notch and actually trade with precision, then it's time to talk about advanced charting techniques. These are the tools and strategies that go beyond guessing and help you truly understand market structure, momentum, and price behavior. And the best part is, once you get the hang of it, they become second nature. So let's break down some of the most effective advanced techniques that pro Forex traders use, right here on FX Limit. Let's start with one of the most useful habits, using multiple time frames. This alone can change the way you trade. If you're only looking at one time frame, you're missing the bigger picture. A pair might look like it's about to break out on the 15-minute chart, but a quick glance at the 4-hour might reveal you're heading straight into resistance. Multiple time frame analysis helps you align your trades with the overall trend, avoid false signals, and enter with way more confidence. Next, you've got supply and demand zones. Unlike simple support and resistance lines, supply and demand zones are broader areas where big moves originated. Price tends to react to these zones because that's where institutions previously placed large orders. When price comes back to these zones, you often get strong reactions, either bounces or breakouts. Drawing these zones properly helps you anticipate entries, stop losses, and exits with more precision. Another high-level technique is identifying liquidity grabs. These are fakeouts that occur when price breaks a key level, takes out stop losses, and then reverses sharply. It's one of the most common traps that catches new traders off guard. Spotting these setups is all about watching price behavior around key highs and lows, and recognizing when a breakout lacks follow-through. Mastering this one technique can prevent a lot of bad trades. Divergence is another underrated charting signal. If price is making higher highs, but your RSI or MACD is making lower highs, that's a warning. It tells you the momentum is fading even though the price is still rising. Combine this with a break in market structure or a failure to hold a key level, and you've got a potential reversal on your hands. Now, all of this takes practice and screen time to get good at. But there are tools that can help speed up the learning curve. One example is the Apex Trend Indicator. It's not trying to replace your analysis. It actually supports it by visually confirming trends and helping spot high-probability setups. You get clean color-coded trend lines, non-repainting buy and sell signals, and even a built-in win rate stat. It's like having a second set of eyes on the market, so you're not missing the obvious while you're focusing on the advanced stuff. Confluence is key when using advanced charting. The more confirmations you have, the better your edge. Say you've got a strong demand zone, a bullish divergence on the RSI, a break of structure, and the Apex Trend Indicator flashing a new buy signal with a solid win rate. That's the kind of setup that gets serious traders excited. The more you stack your confirmations, the more confident you'll be in your trades. That's really what advanced charting is all about. Not doing more for the sake of it, but finding smart ways to build confidence in your setups, so you're not just reacting, you're anticipating. So if you want to trade like the pros, don't just rely on one indicator or one pattern. Learn to read the story the chart is telling you. And if a tool like the Apex Trend Indicator can help highlight key moments in that story, it's definitely worth having on your side. That's it for today's video on FX Limit. Make sure to subscribe for more breakdowns like this, and leave a comment if you want us to dive deeper into any of these strategies.